Hello, my name is Ray Franklin. I'm the Senior Commodity Analyst for Energy Professionals. Today's video is a summary of my March 11th energy update, in which I'll explain why natural gas prices are trending higher after EQT and Chesapeake Energy announced production cuts. I focus on natural gas because it is the largest source of power for the generation of electricity. Therefore, their pricing is highly correlated. In our previous report on February 26th, we explained why natural gas producers will be forced to cut production in response to today's unsustainably low pricing. And prices are unsustainably low when they decline below the cost of production. And producers respond by making strategic decisions to curtail production to support higher prices in the future. And this is precisely what is happening. Last week, EQT, presently the largest United States natural gas producer, announced it made the strategic decision to cut production by approximately 1 billion cubic feet per day, starting in late February, and they'll continue to maintain this curtailment through March, and then reassess market conditions thereafter. And although they're keeping their options open, they will likely maintain lower production while prices remain low. Also, when Chesapeake Energy announced on February 21st, in response to the recent plunge in prices, that they were cutting the amount of fuel produced in 2024 by roughly 30%. And as you can see from this chart, natural gas immediately reversed its decline to $1.52 and has continued to trend higher. The market's response to this news was appropriate, given that Chesapeake Energy is expected to become America's largest producer of natural gas after its merger with Southwest Energy. And in addition to the two largest producers cutting production, it is important to note the cuts are expected to be industry-wide, as confirmed by Baker Hughes's latest report revealing America's natural gas drillers have decreased the number of active rigs over the past year by 25%. The Baker Hughes rig count is an important barometer of future oil industry drilling production. In our February 26 energy update, we said prices were not expected to remain near today's very low prices for an extended period. Therefore, natural gas' recent rally was not unexpected. We came to this long-term conclusion by reviewing data from the Energy Information Administration, that's the EIA's website, which revealed there were two similar instances in 2012 and 2016, when natural gas's total supplies were higher than where the supplies are expected to be this year on March the 8th. And in both cases, natural gas prices were much higher by the end of the year. Why? Simply because prices were unsustainably low. In 2012 and 2016, similar to this year, we experienced warmer than normal winters, resulting in supplies reaching record levels. But by the end of the year, prices more than doubled. The takeaway from 2012 and 2016, when natural gas near the lowest prices since 2000, and with EQT and Chesapeake Energy announcing production cuts, the conditions supporting a major bottom in natural gas are in place. And although prices could go slightly lower in the near term, the average price of natural gas will likely be much higher long term. Therefore, if your present energy agreements expire in 2024 or 2025, we recommend taking advantage of this year's recent plunge in prices and reserve energy to be available when your present agreements expire. We believe the average price will be higher long term, and the upside risk is far greater than the downside potential of waiting, hoping for slightly lower prices. We realize not every client's risk tolerance and hedging strategy are the same, but hopefully today's report helps put into perspective your risk-reward opportunities. And we invite you to call one of our energy analysts to plan your hedging strategy that would be appropriate for your situation. And until my next report, please take care.